All right, so today is Wednesday, October 23rd. This session is being recorded. What we're going to do today is primarily work on the valuation of Nike. So you need to have the Excel model that you turned in for your last homework assignment last Wednesday, open and ready to go in just a couple minutes. We're going to start continuing to do the valuation of Nike. That will complete the reusable valuation model, which you could potentially turn in at the end of class today. Okay, that's Monday's homework assignment. Now, while you're doing that, a few things. One, here's the attendance sheet. Make sure you sign the attendance sheet before you leave today. Two, last week, the second half of the Bloomberg Trading Challenge has started. Today by 4 p.m., you have to be below $300,000 worth of cash. So, looking quickly at the trading challenge. TMSG, this is section 301. So started last week. So it would be 443 fall 24 301 2H second half. So anything with 2H next to your section is where we start. So you need to make sure your team captain goes that drop down. Okay. So the good news is all 6 teams in this section are below 300,000 of available cash. That is good. That's not the case in the last section. In fact, one team hadn't even started trading yet earlier today. Okay. So again, for all teams by 4 p.m. today, you have to be below, too late if you're watching this video, 300,000 of available cash and stay that way for the rest of the semester. Right. Now, by the end of the semester, you need to have at least 10 longs. Right. 4 of the teams in this section have met that requirement. But that requirement is not today. That is by the end of the semester. Right. Any questions about the trading challenge? It's your ranking as we get started. Everybody's pretty close. All right. Now, the final thing is your team project grades on Monday. You must complete a peer review shortly. Deadline for the peer reviews are due very quickly. What you need to do is take this Excel spreadsheet you submitted for peer review 1 and basically add another column. Say historical, put in the percentages, upload it. Make sure you do that by the deadline. Okay, it's peer reviews are due very quickly. As a matter of fact, time-wise, assignments, peer reviews. Historical, October 24th, so that's tomorrow, end of day. Okay. And then finally, your group project grades are not final. Okay. When I listened to your group projects, some of you had incorrect data, including some of you in this section. You did not have the correct ROIC tree, did not have the correct CFI. I did not deduct any points for that on Monday. I basically graded you as if you explained the incorrect data. Okay. If you have incorrect data, I'm taking 2 additional points off your team project grade. Okay. Because you're going to have both the incorrect ROIC and the incorrect CFI. I've not done that yet. I will post a solution for Delta. And if you're a team with incorrect data, your team grade is going down by 2 points. Okay. So just letting you know. All right. Yes. A column for what? Sorry, what's the question? Well, you're talking about for the peer reviews. So let's just say column A is the name of the 7 or 8 people on your team. Column B is the percentage effort for the EIC project. Column C would be the percentage effort for the historical project. That's when you might add another column. So just take the file you submitted with the peer reviews, you got his names, percentage, just add the column for the next team project and put the percentages for that team project in that next column. Easiest way to do it. Yes.
I was just wondering, does it have to be the same Excel box already?
It doesn't have to be, but as long as you have the second peer reviews in there, that's different for the first, that's what needs to be submitted. Okay. And for the vast majority of you, it was 100%. Like, that's good. I want everybody to equally contribute. I don't like when people have to get their grades adjusted down. So hopefully everybody continues to contribute and it's an easy peer review for most of you. Any other questions? All right, so let's talk about finishing up the valuation of Nike. So we want to take the file from last Wednesday. So this is the one from the video last Wednesday. And you don't have to do this, but I'm going to save mine as Nike. And we're going to call this the as is, for reasons to be explained later. This is section 301, which is the video. All right, so reminder what we did. We took 6 years of forecasted ratios for Nike. That created 6 years of forecasted income statements and balance sheets for Nike, which created 6 years of economic statements forecasted for Nike. And the most important one were 6 years of cash flow forecasted on the CFI. All right. What we're going to pick up right now is we're going to take that forecasted cash flow and we're going to turn that into an enterprise DCF valuation. Okay. And then we're going to put in more realistic data and we're going to value Nike to a current share price of $80.50 a share. Okay. That's our plan for class today. So picking up the very last tab, we're going to add a worksheet and we're going to call this the DCF valuation. All right. So Modigliani Miller, operating value plus non-operating value equals enterprise value. Forecasting operating value is free cash flows. So we're going to start with the forecast of the free cash flows. So cell B1 on our new worksheet, free cash flow. The first year forecast, A2 equals CFI H3 or H2. Okay, so 2025. And we're going to take the next 5 years, so equals that year plus 1. And copy that down 3 more times. So relative forecast through 2029. So those are the next 5 years of forecasted free cash flows for Nike based on our model, right? So right now, 2025 free cash flow forecast for Nike, B2 equals the CFI tab, free cash flow, it's row 14. 2025 is H, so H14. 2026 free cash flow from the CFI is I14, relative reference. 2027 free cash flow forecast for the CFI is J14. 2028 free cash flow forecast for the CFI is K14. And 2029 free cash flow from the CFI is L14. Those are the next 5 years of free cash flows, assuming our ratios come true. For formatting purposes, I'm going to select these 5 years. Format, comma, 1 decimal place to match the rest of the model. Now, what I next need to do is I need to present value these cash flows. I do them to today's values. The forecast for present value is cash flow divided by 1 plus R to the N or T power. Okay. So you can either use Excel to do this, or what I'm going to do is if you take the cash flow and multiply by 1 over 1 plus R to the N. That's called a discount factor. Okay. So I'm going to multiply the cash flow by the discount factor. And that's going to get me my discounted free cash flow. So in 2025 equals 1 divided by left paren 1 plus R. The R is assumptions B4. It's the WACC. Right paren. So if I take 5346.2 B2, multiply it by the discount factor 0.912, whatever, C2, I get 4877.94. Yes. Sure. 1 divided by 1 plus R. The R is assumptions before, which is the WACC. Now I'm going to copy this down for the following years. So I want to make B for an absolute reference. So put a $sign in front of the B and a $sign in front of the 4. Then what I'm going to do is I'm going to take column C, I'm going to format it to a few less decimal places, make it less ugly. And column D, comma 1 decimal place. And I'm going to take C2 and D2, copy it, select down to C6 and paste it. So I'm just going to present value each of the 5 years. Now, when I get to 2026, the discount factor is 1 divided by 1 plus R squared. Okay. So in C3, at the very end, shift 6, 2. That's squared. In C4, 1 divided by 1 plus R to the 3rd power. So at the end, shift 6, 3. In 2028, shift 6, 4. And 2029, shift 6, which is called the caret 5. All right. So basically what I've just done is present valued those 5 free cash flows to today. That's the important part. Now that they're in today's value, I can add them up. So the operating value in the first 5 years is the sum of those 5 forecasts. So if the forecasts are accurate, Nike is going to generate 20.58 billion of operating value over the next 5 years. That's the free cash flow value, present value today. But Nike doesn't just end in 2029. They're going to continue on, right? So what we do for companies is we assume they continue on for a long period of time. So that's called the continuing value or terminal value period of a company. So for Nike, we're going to start in year 6 and call year 6 forward as the continuing value, perpetuity value of the company. That's just arbitrary. Okay. So we need to start in cell A9, estimating the long-term or continuing value of a company. Now we're going to do that in cell B9. Now what we're going to do for long-term value is we're going to use this formula right here. That's the key value driver formula. That's a long-term growing perpetuity. So that long-term growing perpetuity key value driver formula is the formula we're going to use for continuing value, right? So you don't need to do this, but just as a reference, I am going to copy this formula. Copying just the formula. And I'm going to put this in Excel. So basically what we're going to do is we're going to put this formula into this cell to estimate the continuing value of Nike. That formula has 4 numbers. four values. We need to know the expected profit, which is the NOPAT. We need to know the expected ROIC, long-term ROIC. We need to know the very long-term growth rate, the G, and we need to know the WACC, right? Because that will change company by company, we're going to put those into the assumptions tab. We already have the WACC as placeholder. Now I need the next three values. I need an expected NOPAT. I need an expected ROIC. And I need a long-term growth rate. Not a 3-year growth rate or 5-year growth rate. Think of this as like a 30 or 40-year average growth rate. Right? So those are the other four values of the formula. Since those are going to change, yellow. Got a placeholder for WACC. I need a NOPAT. What NOPAT I'm going to use as a starting point? So B5 off of assumptions equals TII. The 2030, column M, NOPAT, which is row 5, so M5. 2030 is the beginning of our continuing value or perpetuity period in the model. It's the last year of the model. So 5460.9. Potential midterm question, but as the book talks about for best practice, you always forecast a T+1 or an M+1 year. So if I forecast 5 years, I forecast year 6 as the beginning of the continuing value period. If I forecast 10 years, I make year 11 the beginning of a continuing value period. So whatever model period you use, you always use the last period, a +1 period, to start your continuing value or terminal value. That's just a best practice. Right? Now, those numbers in year 11 or year 6 or year 3, whatever terminal value we start, should have two parts. Number one, ideally, we want the company to be stable when we go to continuing value. Because they're such critical numbers of the long-term value, it's better if the company's mature than if the company's in hyper-growth mode, right? So 5 years of forecast may not be enough if we were trying to estimate the value of ChatGPT. Okay, they're probably going to keep growing pretty dramatically in more than 5 years. So we might want to forecast them more than 5 years before we went into terminal value. If we want it to be more mature when we're continuing value. If I did a company like Procter & Gamble, I could probably go 3 years of continuing value and not have to worry about it because Procter & Gamble's pretty mature today. Right? So 5 years plus year 6 is arbitrary. And you need to understand that. We are doing an arbitrary period in this model, just for simplicity this semester. Best practice number 2 is that terminal value. You don't want the company, let's say it's a cyclical company, to be the peak or the trough in year 6. Because if year 6 happens to be the peak, you're going to overvalue the company. And if it's the trough, it's going to be the undervalue the company. So you actually want it to be the midpoint of the cycle for a cyclical business. So a couple of best practices. As I said, for simplicity, we're going beyond that this semester, but those are just things to recognize the real world and talk about in the book. Okay. All right. So year 6 NOPAT, 5460.9. The year 6 ROIC equals from the EP tab, ROIC, row 16 after goodwill, 2030, column M, perpetuity, M16. Again, placeholder ROIC. This needs to be a representative ROIC of the long term. And we're saying year 6 is representative. For the G as a placeholder, 3%. Like, why is he using 3%? And the answer is, most companies, when they're mature, tend to grow with GDP. Most European and US GDPs long-term, 2 to 3%. So we're use 3% as our placeholder for Nike. Yes.
So you want the middle year for the arbitrary?
Right now, I want a perpetuity year that represents the long term. Right now, it's arbitrarily 2030. But let's say we were doing a chemical company that's a boom and bust company. if year 6 happens to be in the middle of the boom cycle, I might have too high a NOPAT for the perpetuity. So I might want to try and re-estimate that. That's why it's in yellow as a more realistic midpoint number. Does that kind of make sense? Yeah.
Yeah.
Expected ROIC is off the EP tab M16, which is the ROIC after goodwill in 2030. That's just what we're using as our placeholder. And 3% for the G. All right, that is the hardest thing you're going to have to do today. You gotta take those 4 numbers and with the correct order of operations in that formula, put it into cell B9. Okay, so let's build this together. So for cell B9, equals left paren, working off the assumptions tab, NOPAT, which is B5, times left paren, 1 minus the growth, which is B7, divided by the ROIC, which is B6, right paren, divided by left paren, the WACC, which is B4, minus the G, which is B7, right paren, enter, 76,302.8 million. That is the formula. Move this out of the way. With the correct order of operations. This is being recorded if you want to pause the video. It's just that formula in that cell with those 4 numbers. Yes. That's the key value driver formula out of the book and in most of our lecture notes. So I pulled it off lecture note 1. Other questions? All right, so what we're saying is Nike long-term is going to create an additional 76.3 billion of free cash flow value. But that is in year 6. We got to bring this back to today. We're going to present value this. It's not a present value, it's a year 6 value. So it's January 1st, 2030. Okay, so I need to discount that back to today. So I'll use the same discount factor as year 5. And I'm going to take B9 and multiply by C9 and say the present value of that is 48.249 billion today. Now, you might say, gee, why didn't he discount year 2030? And the answer is because the perpetuity actually discounted year 2030 already. And a common error is to double discount year 2030, right? So perpetuities already discount the current year. So I don't want to discount it again. So I'm basically January 1st, 2030, which is essentially the same as December 31st, 2029. That's why I'm using the 29 discount factor to go back to today. Okay. So the operating value of Nike is the first 5 years, which is D7, plus the terminal value, which is D9. We're saying Nike's worth 68.83 billion of free cash flow operating value going forward, selling their shoes and apparel. Questions? Following Modigliani Miller. Operating value plus non-operating value equals enterprise value. I now need the non-operating value forecast for Nike. Okay, here is where TFI helps us. The 3 non-operating assets that we have to value off the TFI, the excess cash, the non-operating assets, and the long-term investments. So A10 through A12 off of the TFI. Those are the non-operating assets on our standardized balance sheets. I need their values. What we're going to do is we're going to use today's values. So for excess cash, D13 equals TFI. Today, last reported year, G10. Non-operating assets, TFI, G11, and long-term investments, G12. So those are the current value on the balance sheet of the non-operating assets. Right? Assumption. I invest in Nike because they're really good at making and selling shoes. I don't invest in Nike because they're really good at managing non-operating assets. No company is. That's why they're not operating. It's not what they do. So an assumption we typically make is future value of non-operating assets or NPV 0. They're not going to grow the value of the non-operating assets. They'll just kind of manage them, right? So it's the value today. And that's a common assumption we make for companies. However, there's always exceptions. Microsoft struck gold when it invested in ChatGPT. ChatGPT is probably worth 30 or $40 billion today. That's not what Microsoft put in. So the point is, if I were doing Microsoft, that non-operating asset would be a lot bigger. Okay. And I could adjust that. But that's kind of rare. Right. So for most companies, for simplicity this semester, we're going to assume the balance sheet gets it right, even though it often doesn't, but it's not the biggest value of most companies. Okay. Cash is usually cash. That doesn't change. It's the investments in other businesses that could change. Right. And I know what accountants do, because unfortunately accountants have a floor for those, meaning they'll write down the value of assets. So what's on the balance sheet's a floor, but it's not a ceiling because they won't write up the assets. So it's only when a company has assets that are dramatically different than what's on the balance sheet would we adjust this. If I add these three things up, that would be the non-operating value of Nike. Equals sum of the excess cash through the long-term investments, so D13 to D15. 12,447.8 million. So the enterprise value of Nike is the operating value, D11, plus the non-operating value, D17, 81,277.5. So based on our cash flow forecast, we are saying Nike has an enterprise value of 81.3 billion. Miller, operating plus non-operating value equals enterprise value. Enterprise value equals the value of the interest-bearing debt plus the equity. If we take the enterprise value and subtract the debt, we get the equity value. If we're trying to get to a share price, after we pay off all the debt, we pay off the non-common shareholders. The residual, what's left, is the common equity value divided by share price. All right. I told you that you would hate the conversion, but I said the benefit of the conversion is everything becomes extremely straightforward when you do the valuation. Okay. So here's the point. Enterprise value 81 billion. Who do I have to pay off before the common shareholders get their money? The first people I pay off, TFI. I got to pay off the retirement related liabilities. The next people I have to pay off, TFI, interest-bearing debt. The next people I have to pay off, preferred shareholders. Next, I have to pay off, TFI, minority shareholders. I don't pay off the common shareholders, I solve for them. Common shareholders get what's left after everybody else has been paid. So after I pay off those four people, those four stakeholders, I will be left with a common equity value of the firm. What do I owe my retirement related liabilities? Well, today, cell D21 equals TFI, current year reported 2024, so G15. My interest-bearing debt, TFI, G16. My preferred shareholders, TFI, I owe them G18. And my minority shareholders, I owe them TFI, G19. So my common equity value is my enterprise value minus the sum of those four things. So D21 to D24. 69,325.5 million of equity value. If I'm trying to get to a share price, one decimal place, I would then find out the shares outstanding. If I divide that in the common equity value, I would get a price per share. Here's where we go to Bloomberg. I need the current shares outstanding for Nike. It's not in the income statement or balance sheet. Okay, this is where screenshots start coming in. You go to Bloomberg. You go to Nike. First screenshot, DES. Also a security description. On the DES screenshot, you'll get two pieces of data. First, down here, when you scroll down, there is the current shares outstanding. Just easy to find in Bloomberg for any company. Okay, for Nike, 1,190.6 million shares. So 1190.6. So next assumption, A8, shares outstanding. The other assumption, yellow. But type in that number, it was 1190.6. Next assumption, I need the current share price of Nike. Now, at the top of my DES screenshot, 80.045. Okay, so that's the number I would normally put in. However, for this assignment, I want you to put in $80.50 because that was the price during the 11 a.m. section of the class today. And for your assignment, I want us to have all the valuations based on 80.50. But going forward, you will put in the price at the top of your screenshot. Because let's say I'm going to give you a company next week to value, which I will. I have 192 students. You're not going to do it 192 all at the same time. So Nike's share price was $80.50 this morning. It's $80.05 this afternoon. Okay, tomorrow it could be $79.20 and it could be $81.40 the next day. It's bouncing all over the place. So the reason you're taking a DES screenshot and submitting it is because your model will be based on a price at the time that you did the valuation. Okay, so that's what you're going to do going forward. So two things off the screen: what's the price at the time of your valuation? That's your marker. What's the share count outstanding? For purposes of today, I want the value to be 80.50 as of my screenshot as of 11 a.m. Okay, yes. I do. And I still want you to submit that, because if you don't take a screenshot and submit it, you will get a 0 on the assignment. You don't put that in the assumptions. You put 80.50 in the assumptions and you put in a screenshot, which will have a different share price. Nope, it's going to be your Excel file and then 5 screenshots. That's your assignment. And this is screenshot number 1 that you have to submit. And the reason why you're going to submit all 5 of these screenshots is because this is your recipe. These are the data you're going to need from Bloomberg to do another company. I want you to get in the habit, figure out where that data comes from. And every time you submit a valuation, you're going to submit the data you got for that company. So these are the screenshots that you're going to submit. This is 1 of 5. Yes.
So as long as we have the number.
Correct. And it won't be 80.50. That's okay. Still got to have the DES screenshot right now, whatever it is. Yes. That's the first of 5. There'll be 4 more. But going forward, you would put the top number on that screen into cell B9. For this assignment only, you're going to put in 80/50. Okay. All right. So here's what we're going to do. We're then going to go back to our valuation tab. And we're going to reference the shares outstanding. Because again, this is going to change company by company. So I don't want to put this here. That's why we put in the assumptions. Okay. So equals assumptions B8. Price per share equals common equity value, D26, divided by shares outstanding, 1190.6, 58.23. So our model is forecasting a share price of 58.23. This is a working enterprise DCF model. Very real world. You can use this today to value Nike. We just did. Okay. Now, we've come up with a price of 58 in our model. In the real world, they're trading at 80/50. So here's what we need to do. On the ratios, in F26, I want you to type in current share price. In F27, I want you to type in model share price. In G26, I want you to reference assumptions B9. And in G27, I want you to reference DCF valuation D30. So here's the deal. This is the current share price of Nike, and this is the model share price of Nike. Our task in the first of 4 Excel models that you will create is to match these two. Exactly. I need my model to be 80/50. That is what we will call in this class an as-is valuation. We value the current price of the company. Whatever it is. Whether we agree with it or not, that's the price of Nike. And these cash flows will represent that share price. That's called an as-is valuation. It's not your opinion. Your opinion will be Excel model number 4 called a target valuation, which we'll do on Monday. What do we think Nike is worth? And that will also involve a bull and a bear. How high could it go? How low could it go? And where's the target? And that will help you create your buy, sell, hold recommendation, right? But in order to get there, we need a baseline. This is the baseline. This is the price today. And I want to understand the price today before I start forecasting your price tomorrow. Make sense? So our task is now, before we leave, to get these two share prices to match, the model and the actual. So we're going to make Nike more realistic. But before I do, questions about anything so far? Yes. Don't care. And I say that not to be mean. I'm saying it because right now, the price is the price. And so in the as is, it's not my opinion. It literally is an 80/50 price. So model the 80/50 price. That's called the as is. The next part of your question is, do I think it's overpriced or not? That'll be another Excel model where I'll put in more realistic assumptions that I believe, which will create a different price. That's a second model. Everybody see the difference? But that's not today. We'll do that Monday. Okay, today we just want to model the current price. And we'll do that for every company. Every company will model the current price. I could give you DJT, a company that makes no economic sense. You got to model it with a cash flow. I should make that an assignment because it's crazy. Like you're going to come up with some really weird numbers because the model, just cash flow just doesn't make any sense. But you still have to do it because that's the price. Okay. Now you can come up with a value that says this is crazy talk and it's not worth this, and come up with a different model, which is what every analyst on Wall Street does, which is why they all have sell ratings on it. But basically, get out. You're being screwed if you own that company. It's just a mem stock, but that's just an opinion. I'll get out. So back to this. Match Nike 80/50. All right. So how do we do this? We need operating value that's more realistic. if you look at enterprise value, the bigger part is usually operating value of almost all companies. So we got to get the operating value. And operating value is based on free cash flow. So we got to get free cash flow right. And we got to get the growing perpetuity right. That's most important. So ratios. 3 rows in the column A are grayed. Revenue growth rate, EBITDA, tax rate. Those are the 3 most important ratios to forecast free cash flow, because that's gross cash flow. Okay. So I got to get those right to get my gross cash flow. To get free cash flow, I also need gross investment. Here's where those balance sheet ratios help. Every one of those balance sheet ratios is a percentage of revenue. Accounts receivable is a percentage of revenue. Inventory is a percentage of revenue. Net fixed assets is a percentage of revenue. As the model grows revenue, it grows the balance sheet because everything's a percentage of revenue. Gross investment is the difference between 2 balance sheets. So by forecasting revenue, we've actually set up a model that auto forecasts gross investment. We don't have to worry about that. What we have to forecast is revenue, margin, the tax rate to get our gross cash flow. So let's get those right. So I need a realistic tax rate going forward for Nike. Where do I get that? Screenshot number 2. Go to Bloomberg. Type in GUID. That stands for guidance. In the real world, investors need Nike's tax rate to know what to value Nike. The company needs to know what their tax rate is going forward when they forecast. So most companies will give guidance to Wall Street and say, hey, this is what we think our tax rate's going to be long term. So on GUID, tax rate guidance, Nike, blank. Nike is an exception. They don't give tax rate guidance. But we still need it. But this is your second screenshot. So even though it's 0, even though it's blank, you're still turning it as a screenshot, because if your next assignment were Walmart, Home Depot, then they give tax rate guidance and they're saying long-term, we think our tax rate is going to be 25%. Right? So we'd use 25% if this was Walmart, but this is not, this is Nike. So step 1, guidance, screenshot, take it, regardless of what's there, submit it. It's not there. So I still need a tax rate. Step 2, BRC. Go back to Nike. And BRC, you know this from your EIC assignment. These are the analyst reports. Through our license, we have access to JP Morgan analyst reports. What I know about JP Morgan is, like every other sell-side analyst, they're trying to do exactly what we're doing. They're trying to estimate the tax rate. So what we're going to do is we're going to copy their homework, right? Because just like us, if the company doesn't give us, JP Morgan's trying to figure out, what do I think Nike's going to pay long-term? And they're pretty smart people at JP Morgan. So we're going to use their estimate for a company's long-term tax rate if the company doesn't give us one. Now, step 3, come up with your own. But I don't think anyone in this class knows more than the sell-siders at JP Morgan on what's covering a real company. So, but anyways, that would be the 3rd step. All right, so how do we do this? Go to JP Morgan. Here's one on October 14th. And the reason I'm picking JP Morgan is I know JP Morgan always includes a copy of their model in every research opinion. So I know the tax rate's in it. So go to search by keyword, tax rate. And these are JP Morgan's estimates in the out year, 18.4%. Right now, JP Morgan is estimating an 18.4% long-term tax rate. That's the number that we're going to put in cell H10. Question? Yes. Go to BRC, open up JP Morgan, first one you find, most recent one preferably, and search for tax rate. Yes. For this purpose, no, because I know 192 of you would submit the same screenshot. So that one you don't need. That's not a screenshot, it'd be a PDF. Okay. But what I'm saying is, if this were your assignment next week, you didn't have the guidance, you'd have to explain that you got in your paper, that you got it from JP Morgan. Questions so far? All right, I skipped one, I'm gonna go back. Screenshot number 3. I need in my model assumptions, a more realistic whack. That was just a placeholder. I need today's whack. I don't need some random whack. I need Nike's whack. So screenshot number 3, go to Nike, type in WACC, screenshot this and type in their whack. Today, 8.9%. So assumptions before, 8.9%. When I put in a more realistic whack and I put in their tax rate, I'm now at 6203, closer to 8050. But we're not done. Next, I need realistic EBITDA margins. And I need realistic revenue growth rates for Nike. Since we're doing it as is, this is where we're going to use the Wall Street consensus to help us out. We're going to then go to EEO. Here is a forecast for revenue, row 13 for Nike for the next 4 years. Here, row 17 is a forecast for Nike's EBITDA for the next 4 years. If I divide EBITDA divided by revenue, that's called EBITDA margin. Hiding here in plain sight is a forecast for EBITDA margin for Nike for the next 4 years. I have the 25 revenue in this column. I have the 24 revenue in this column. I know revenue growth is percentage change, which is current year minus previous year divided by previous year. It's hiding here in plain sight are the revenue growth rates for Nike going forward. So this part is just transposing. So what we're going to do on the assumptions tab is starting in C12 equals last reported year plus 1. And I'm going to go across 5 years. So starting with D12 plus 1. And I'm going to do that 4 times until I get to 2029. And then what I'm going to start typing in row 13 is the expected revenue for Nike and the expected EBITDA for Nike. And when I divide the two, I'm going to get the estimated EBITDA margin for Nike for the next 5 years. Okay. So now we're going to transpose. Screenshot number 4, EEO. You're going to take a screenshot of this, or you're typing the data. So starting in 2025, Nike's revenue, 47,606. So 47,606,000,000 in 2025. In 2026, 49,768. 49,768. For 2027 revenue, 52,634. For 2028 revenue, 56,634 or 643. 56,643. And for 2029 revenue, year 5, I have to scroll over a column to get to 2029, which is 59,439. And that is my final screenshot, number 5. I call that EEO2. Because Bloomberg only shows you 4 columns and I need 5 years, I want you to take 2 screenshots. The first 4 year on the first screenshot and year 5 of the second screenshot. Yes. Move over a column to C29, take a screenshot with it includes 29. Submit both. That's the fifth screenshot. Yes, correct. DES, guidance, GUID, WAC, EEO, EEO2. EEO2 is just the fifth year off the EEO. Yep. The WAC is the WAC, stays WAC.
So the period there's one like most recent.
Nope. The WAC you're gonna use is today's WAC, which is right here. MR is most recent. Other questions? Yes. Short version is the numbers that you put in Excel are the current numbers, with the one exception of the share price being in the 11 a.m. section that I'm putting in right now. Whether you submit those numbers or different numbers, don't care, just want the screenshots. So your screenshots will be different than the numbers, the model potentially. That's okay, as long as you submit them by Monday. But the reason I'm asking you to do the screenshots, because as I said, when I give you the company next week, you're gonna need the data from those 5 screenshots to do the company. Everyone's Excel files are gonna look the same. Your screenshots might be a little different. That's okay. Because that's the whole point. Next week, new company, your Excel files are all gonna be different. So for the TAs to grade you on a bunch of different files, they have to know what data you put in at the time of the valuation. Does that make sense? Okay. All right, so yes. Which one? So that's the point. Just go to EEO. Row 13 is forecasted revenue, starting in white, those are the next 4 years. So 2025 revenue, 2026 revenue, 27 revenue, 28 revenue. 2025 EBITDA, 26, 27, 28. Because there's only 4 years on here, you gotta go over a column to get to 2029. There's the 29 revenue, there's 29 EBITDA. Other questions? All right, so here's the deal. I gotta do the same thing with EBITDA. 2025 equals from Bloomberg. Go back a column. 2025 EBITDA, 5546. $2026 EBITDA from Bloomberg, 6375. $2027 EBITDA, 7033. $2028 EBITDA, 8334. $2029 EBITDA. Column 9356. So my EBITDA margin, 2025, cell C15 equals my EBITDA, C14, divided by revenue, C13, 11.6%. Copy that formula. Go to 2029, paste, growing to 15.7% EBITDA margin in 2029. These cells from C13 to G14 are yellow. Once you get this, we want these margins to become these margins. Okay, so I'm just going to reference them. So 2025 EBITDA margin equals the ratios assumptions, C15. This is D15, E15, et cetera. So I just copy this over the next 4 years. So those are the next 5 years of EBITDA margin based on the consensus estimates. Just put them on the ratios tab by referencing. Notice the share price is now higher. It's up to 69 as I put in more realistic margins. Finally, I need more realistic revenue growth rates. I know the formula for revenue growth rate mathematically, current year minus previous year divided by previous year. Okay, so for 2025 equals left paren. The current year forecast in 2025 is assumptions C13. The previous year, so minus the previous year, is off the income tab because it's actual. 2024 revenue, which is G3. That's my historical year. Take all of that and divide by last year's revenue, which is income G3. And I screwed something up. All right, circular reference. Equals left paren, assumptions, C13 minus income G3 divided by income G3. There we go. Minus 7.3%. Right. By the way, if I went to Bloomberg and I switched to headline growth on EEO in 2025, negative 7.31%. Bloomberg's doing the exact same thing. They're just taking the two revenues, calculating a growth rate. That's the current revenue growth rate based on the consensus. Right? You do the same thing for 2026, except 26 becomes easier. So in 2026, the growth rate is equals left paren, 26 revenue, D13 minus 25 revenue, C13 divided by C13, 4.5%. In 2027 equals left paren, revenue, E13 minus D13 divided by D13, 5.8%. Since I'm just doing columns across, I can copy 27 all the way through 29 and paste. So those are the next five years of growth rates for Nike. Yes. I did what? I use the amount for the income tab only for 2024 because that was historical. Since I put the 5 forecast years, I use the rest off of the assumptions tab. Because those are forecasts. Yes. What is that? That's a weird number I need to get rid of. Current year minus previous year divided by previous year. That's all it is. By the way, when we put in a little bit more realistic growth rates for Nike, share price, 78.67. Getting really close. Yes. Current year divided minus previous year divided by previous year. That's all it is. All right. Now that we have put in the next 5 years, growth rate, margin, tax rate, now that we have a more realistic WACC, our final part is the perpetuity. Now we have to worry about column M, right? 20, 30 years. Okay. So what I need is 3 things. These are the last 3 things. Do I have a realistic perpetuity EBITDA margin? That would be a question. Do I think 15.7 is realistic in perpetuity? Let's assume that I think it is today. Okay. That 2029 is representative of the long term. We'll leave that in for now. Do I think that the 2030 single year growth rate is going to be around 5%? I should have done an EIC, but I see that Nike's growing low to mid single digits for the next 5 years. So 4.9% in year 6 alone doesn't seem unreasonable. So I'll leave 4.9. My final number that's going to be the most important number. What's the long-term growth rate for Nike? Not the 2030 growth rate, but the 40-year growth rate. Okay, that's going to be key. What's my G? So here's how we're going to get to G. We're going to goal seek it. Okay, we're going to solve for the G long-term that gets us the current share price. Okay, so tools, goal seek. And what we're going to do is we're going to set cell, DCF valuation, the share price. So D30 to the current share price of 80.50. And we're going to tell Excel to keep iterating the G, B7, until they get this model to stop at an 80.50 share price. And when we hit OK, the answer is 3.2%. So to 3.2% G, our model now has an 80.50 share price. We matched. Now it is manually. You just keep throwing G's until you get those numbers to match. But goal seek is a little bit more efficient. Yes. Sure. I told you learn Excel if you don't know Excel. So a little trick in Excel, goal seek. Works anywhere. Tools, goal seek. So what you're going to do is you're going to say, okay, the number that I want, share price, valuation D30, I want that value to be 80.50. It currently wasn't. And I want Excel to keep changing the G until it gets to 80.50. So change this cell and iterate through to get to 80.50 and then stop. That is B7. When you hit OK, Excel is going to keep iterating until it gets to 80.50, and that happened to be 3.2%. This is Nike share price right now. 80.50 a share. This models it out, cash flow basis. If you were to pick up a Wall Street model, you're going to see numbers plus or minus a little bit close to this. If they were modeling current share price. This is real. It's called the as-is. But we're not done, right? But you're done for purposes of your homework. So if you've gotten to this point, you got that share price and that G, and everything else, you can submit homework 9. You can submit the Excel file and the 5 screenshots. DES, guidance, GUID, WAC, EEO, EEO2. Yes. Correct. They got to be 80-50. Other questions? Yes. No. Well, it is okay, but you're going to 0 on the assignment. It's okay as you want, but you got to match. Go back and watch the video. What I'm guessing, I did a little dyslexia earlier in a previous section, typed in the wrong number. Probably what you did. There's a lot of numbers we were typing in. You might have easily typed in the wrong number. All right. Other questions? Yes. On Monday. So here's the point. This is what's going to be graded on Monday, but you have additional homework for Monday. So on Monday, we'll finish up Nike. We're going to do 3 more files, a Bull Bear and a Target, right? Then on Monday in class, we're going to do another company. Should take you about 10 minutes using this model. Pick Home Depot. So we'll do Home Depot. Won't be Home Depot, but let's say I did. They'll do Home Depot in class. And then your next homework assignment for the following week, so I'm going to give you a company, you're going to do the full valuation, write a 500-word paper on why you used all the assumptions you did, but you got to be able to use the reusable model. So how do we make this a reusable model? What's key is model data. This is the data that comes from Bloomberg, the raw data to have the historical baseline for Nike or any other company set up in the model. So if I want to do another company, I need this data for that company in this exact format coming from Bloomberg. So here's how you're going to do it. You're going to go to your individual Bloomberg account. You're going to go to FA. which is historical data. You're going to go to custom. And you're going to create a custom FA template. And that template needs to match the model template. That model template is 6 years of historical data. By default, Bloomberg sets you up to export 10 years of historical data. So this period needs to be 6. So you don't forget to change it to 6 every time. You're going to go to settings. And where it says number of periods, you're going to change 10 to 6. And as you can tell Bloomberg, every time you export data, just give me 6 historical years, not 10. If you put 10 in the model, it'll break it. Also, it just wants 6 historical years, nothing else. So you're going to go to the data tab. Make sure these 4 boxes are unchecked. Because if any of those boxes are checked, Bloomberg's going to give you more than 6 columns of data. And when you put more than 6 columns of data into our Excel file, it's going to break it. So I don't want anything else. Okay, so make sure those 4 are unchecked. Then update. Right, and then finally, this is the tedious part. Here's what we need to match. In our model, column A and B are the most important columns. Column B is the database name. That's the actual database field that will never change in Bloomberg. Because if it did, cataclysm would break out on Wall Street. Because people at the banks are literally referring to sales underscore rev underscore turn for revenue. And they always expect it to be revenue, and it should never change. Column A is the friendly name. That changes all the time. Okay? So in the US, we call revenue revenue. In the UK, they call revenue turnover. So if I look at a UK company, it'll say turnover, but both point to sales rev turn in the database. Okay, so here's what you're going to need to do. Starting on your template, in this exact order, you're going to take sales revenue turn. So copy B6, go to Bloomberg, where it says enter field, paste that database name, select the first option down. Hover over it. Excel field ID, sales, rev, turn. The next one down that you need in this exact order is cost of revenue, which is IS COGS to fee and PP and G. Go figure that you create that database name based on that friendly name. Take B7, copy it, go to Bloomberg, enter field, paste, select cost of revenue, make sure, repeat that process 78 more times. Okay? When you have completed that process 78 more times, you are going to have a template that looks like this. Save that template. Mine is called model. You can call it whatever you want, but you will need that to export the data to reuse this file. Yes. Correct. 192 people manually doing that 80 times for that template one time. It'll take you 10 minutes. You probably do it right now, but you have to do it by Monday. Because here's what's going to happen on Monday. Let's say I give you Home Depot. I'm just going to say get Home Depot's data. If you don't have this template, you won't be able to do the in-class assignment. Let's say I say your homework assignment is Google. If you don't have this template, you cannot complete next week's assignment or any other assignment I give you for the rest of the semester. So you have to have this template. And it's got to be this exact template, because if you have any mistakes, you leave something out, you put it in the wrong order. If you put it in our model, your model won't work. So this is a very important part of the process. So I'm not asking you to do this for homework per se for Monday, but I'm telling you, if you don't do it by Monday, you're not going to be able to continue. Other questions? Yes. Here? No, they're all millions. Other questions? All right, something to be warned about. Of the 80 fields, when you're doing this row by row, you will not find 2 of them. You'll put in the database field name and it won't find anything. You'd be like, that seems strange. Because Bloomberg has a bug and they haven't fixed it. We told them about it, they haven't fixed it. It's there. You just can't find it. What do? Type in the column A friendly name. Type in the column friendly name and it will find the column B database name. It'll do that for 2 out of the 80. Why? I don't know, but just it's software. That's basically the short answer. But for the other 78, it will find the actual database. It's there. For some reason, it just has trouble searching for it. Okay. Questions? Once you save that template, here's what will happen on Monday. Let's say I do say Home Depot. Here's Home Depot's data. Here is the Home Depot's data in that model template. Export, Excel, that template. And then in Excel, is Home Depot's data for the 6 historical years. We'll copy that data and overwrite the first worksheet, and then Nike becomes Home Depot. So that's what I said. It's very quick once you have this template to reuse the model, but you got to have this template. All right, so what you need to do between now and Monday is really 3 major things. Number 1, complete the pure evaluation by tomorrow midnight. Number 2, turn in the Nike model at 80.50 a share, at 3.2% G, that basically matches what we did in class. Number 3, submit the 5 screenshots. Okay, that's homework 9. And too late if you didn't, in the other sections, if you didn't get below 300,000 in cash, you're now just screwed. And you can blame your team captain for not doing their work. Hopefully nobody met that threshold. But otherwise, keep trading. You don't go above 300,000. Any other questions? Sign the sign-in sheet before you leave. Beautiful weather out there. Go enjoy the rest of your day. See everybody on Monday. Have a good weekend.